All right, welcome back. This 3 minutes to go for the pre-open session. It's going to be a flat start and then a volatile day. I think we can say that with some amount of certainty. There is another new development which we want to kind of address, and this is with regards to a NSE circular which has come through on the options side. Now, what the NSE-based circular basically is saying is that the do not exercise facility has been scrapped, on the option side. Now, let me just quickly explain this with an example, and then we'll get Rajesh Baheti of Crosseas Capital. He's actually with us. Rajesh, good morning. But just to explain to our viewers what this means with a simple example. I mean, suppose, someone is holding stock X the stock X finishes at, say, 2,001 rupees on the day of expiry. And one holds, say, a 2,000 call option, a call option with a 2,000 strike. 250 shares is the lot size. Lot size is 250. So on the day of expiry, you basically end in the money. Now, what the option circular, the NSE circular says that you have to take delivery. That's what the circular says, which means that you have to come up with 5 lakh rupees, which is nothing but 250 into 2,000. You have to come up with 5 lakh rupees to buy those 250 shares at 2,000 rupees. You no longer have the option of not exercising your call. And of course, the question is, what if you don't have 5 lakh rupees to exercise? How disruptive is this going to be? Rajesh, good morning again. Did I explain the problem or the issue correctly? If not, please clarify. And is this going to be a big issue on the option side of things? Go on.
So, good morning, Prashant. Absolutely. Now, you pick up any textbook on options. Any theory on options tells you that the seller receives premium and has an obligation to either buy or deliver the share, but the buyer who pays the premium has the right to exercise that option. What the NSE has done is it's removed that right of the buyer and converted it into an obligation. So to that extent, I think the theory on option trading that we've all been used to has been turned on its head. Having said that, I think they've announced it in advance. So while it is going to be disruptive for the buyers, but I think the wiser thing to do for them would be to square off their position and not wait till the last second, because now they know that that right no longer exists. It has been converted into an obligation.
Do we have any data, Rajesh, which, how many, what's the percentage which just goes unexercised?
So it's not a large proportion. Obviously, if you're going to make money on the contract, for example, if the example that you just explained, that a 2,000 rupee contract, instead of, let's say, ending 1 rupee in the money, it ends 20 rupees in the money. You're making 1%. So you're not going to give that up, and you're likely to exercise or square off that position using another option or the futures. Where the problem might occur is if a security is in a ban period. Whenever that happens, the liquidity just simply dries up, and not allowing traders to trade that security at all because it's in the ban period will make that issue very complicated, because till the last second, the traders will not be able to square off that position. So one of the things that NSE could do is that on the last day of the settlement, the ban period or the penalties for trading that security should not apply.
In any case, Rajesh, brokers kind of discourage options buying close to expiry, right?
So, close to expiry, I could have bought it on the first day of the contract, and I could be holding that option, because it's very difficult for a broker to then figure out now how many people are holding options which become close to at the money at the time of expiry, because I could have bought a 2,000 rupee call option, taking your example, when the price was 1,800. And it so happens that it has gone to 2001 by the time the contract is expired. So it was way out of the money when I bought it, but it has become in the money. The problem is, the theory teaches us that the most an option buyer can lose is his premium. Now here, the obligation can take the losses much higher.
Correct. And this goes into effect from this expiry, Rajesh?
Yeah.
From this expiry. Okay. All right.
Yes.
So that's an important, I mean, it's all, you're saying the impact will not be that much. The percentage which goes unexercised would be relatively small, logically speaking. But now that this is there, one needs to be aware, right?
Absolutely, because 90% of all the trades are anyway in indices which are cash settled. So the problem is only in stock options.
Stock options.
You've
Correct.
got to be careful. That's about it, and not wait till the last second.
All right. Rajesh, thank you very much for that. Appreciate you joining in, and good speaking with you. So, that's the circular, and the impact, as Rajesh explained. Do not wait till the last second to square off